Hi, I'm Nate, and I'm here with an advisory and an apology about why your Roth conversion calculation is wrong. You probably don't know it, and probably neither does your advisor. That's the advisory. Why the apology? Here's why. I've been in financial services software for probably 30 years. So the very problem that your financial advisor's software has is something that I was probably a part of, and it can be fixed. Let me tell you why. There are three main reasons why your conversion calculation is wrong and how professional software is aiding and abetting the crime. Okay. Number one is it's one sided, it looks at the conversion year and not much else. Number two is that it ignores the very thing we're trying to optimize around, which is taxes. It oversimplifies taxes in such a way that your entire analysis is probably meaningless. And number three, it ignores the fact that a dollar today is worth more than a dollar tomorrow. This is nominal versus net present value dollars. We're going to talk just a little bit about each one of those three and what you can do about it. Each one of these has a viable solution. So, number one, the Roth conversion is a two-sided discussion. Okay. Envision, if you will, a pair of shoes that you have wanted for a long time, and you see that they go on sale at your favorite shopping center. That price has never been lower than it is right now. Yeah, yesterday it was more, and tomorrow it'll be more, but today it's lower. Should you run and buy those shoes? Well, the answer is maybe. Okay. It's not a bad decision, but it's an uninformed decision because how much are those shoes selling for at the shopping center around the corner? Or maybe how much will those shoes cost in a week or a month from now? There's just not enough information. That's what's happening with most Roth conversion calculations. You see, software is generally pretty good at identifying a year in which your marginal tax rate, we'll talk more about that in a minute, might be relatively low and relatively as compared to perhaps the years just before the current year or just after the current year. But that's really not the answer. That's really not what matters. That's really not what's of significant consequence. What's of significant consequence is total tax bill on a conversion versus total tax bill on standard distributions of your deferred money. So here's the deal. Others have spoken on this. Let me introduce you to Bob Wolf, a certified financial planner who voices the same concern.
Mistake number two, short-term tax focus. Optimizing for this year's tax bill instead of analyzing their lifetime tax burden across their entire retirement. We're being penny wise and pound foolish.
And here's Zach Call from Capita Financial explaining in a way that perhaps only Zach can do on a presentation with Eric from Retirement Nerds. I want you to pay special attention to Zach's manly brow.
Looking at 1 year tax savings, Roth conversion strategies are not a 1 year strategy. It is too short-sighted, one, and the you have to go back and listen to the first episode about tax rates rising and tax rates dropping to really understand this well. But sometimes people will look at like this myopic view of this year. What's good this year? Well, in that case, traditional is almost always the best, right? Because you get a tax break if you're at the right income levels and the right account types. So traditional almost always wins if you're looking at 1 year alone on the saving side.
Yeah.
On the spending side, Roth always wins because you take it out at tax-free. So it must be at least a 2 year. You can pair a year in the future versus a year now and say, like, I think I'm going to pay a lower tax bracket later than I am today. That's traditional. I think I'm going to pay a higher tax bracket later than I am today. That's Roth. Now, it's better to not just even look at it at 2 years. You want to look at the whole retirement span in retirement and pre-retirement to determine average, like what are my rates like for the most part, set a target, and then you're converting and taking income below certain lines and avoiding it above certain lines. So that's for our next conversation about how to do it right. But the mistake is looking at it in 1 year by itself.
Why is this such a big problem for software? Because it's hard. You see, the tax picture in future years is a hard question to answer. We don't know exactly what our account balances will be in the future. We don't know exactly what our income level will be in the future, and we don't know exactly what the tax environment will look like in the future. But that doesn't mean we can't plan for it. So the idea is project things out using several varying sets of assumptions such that we're prepared for what's to come, and then we can adjust in real time or fine tune year over year from there. Looking only at the year or years of conversion misses half the equation. So why do we do it? Because it's easier. There's plenty of complexity in a 1 year conversion plan, and that complexity goes up exponentially as we introduce future conversions, future tax environments, future income streams, future withdrawals. You get the idea. It's hard, but you can't not do it. Look at both sides of the equation, or you're only getting half the answer. Okay, that's number one. Number two, this is an oversimplification problem. Average tax rate projections and exercises in general are meaningful because they help paint a picture in what is already an inordinately complex environment. If we simplify away the complexity of taxes by just giving it a percentage, we can have healthy conversations about why we do the things that we do. However, we must realize that we don't pay taxes at the average tax rate. No, we pay taxes based on a set of progressive marginal brackets, and then we can calculate the average tax rate based on what we pay. In other words, the average tax rate is the result of the equation, not the driver. So again, if we use that number in the context to explain what we're doing, that's one thing. If we use that number to define the strategy, we're missing the point. Okay? Consider, if you will, for just a minute, that the federal tax system is not an effective, it's not an average, and we're actually not even taxed at the marginal rate. We are taxed at a set of marginal rates where the first dollar is taxed at 10%, and after a while we're taxed at 12%, but only on the portion that exceeds the amount that was taxed at 10%. So we're filling this bucket, and the more we fill the bucket, the higher the next dollar gets taxed. That's complicated, but a required element of the entire Roth conversion discussion. Because if I have an average tax rate of 25%, there may be years in which I'm only taxed at, say, 12 or 22, and other years in which I'm taxed at 37%. And sure, on average, I'm 25%. But the years in which I'm at 12 or 22 are the ones that create the opportunity. Okay, average tax rate is a problem. Capital gains adds an element of complexity here because capital gains, if there is no other income, are taxed at 0%. How does that affect it? Well, all I have to do is start throwing a few dollars of income in, and I go from a 0% capital gain tax rate to a 15% capital gain tax rate. And I've created taxation on dollars that wouldn't have been taxed before. Net investment income. This is an additional surtax, if you will, that is paid on investment income so that folks don't kind of circumvent things by having all of their income from investment income as opposed to, say, wages or what have you, and actually originates with the Affordable Care Act. So you can thank Mr. Obama for this one. But that comes in at a certain threshold. So all of these different thresholds and brackets all have an impact that are well beyond the average tax rate. Social Security taxation is one of these. Out of the gate, Social Security isn't taxed, and as soon as you start making a little bit of money, it becomes incrementally taxed up until 85% of your Social Security benefit can be taxed. That becomes a problem. IRMA. IRMA is a complication that is beyond most people's ability to even understand because it has a 2 year lag. If I break an IRMA bracket in 2024, I finally feel the pain of that in 2026. How do you take into account an IRMA bracket when you're using an average tax rate? And additional phase outs. Consider, for example, the QBI deduction. If you have a small business that is eligible for the QBI deduction, there are points of income at which the QBI deduction phases out and even goes away depending on the type of business. Those things all play out in a marginal system in a way that an average tax rate simply can't do. Now, here's the problem that presents. What it means is that we can't take a strictly formulaic approach at solving the problem. Take, for example, a situation where an individual has nothing but Social Security. As our baseline, the only income stream is Social Security, and as a result, none of that is taxed. That means that we have some headroom where we could do a Roth conversion up to a certain dollar amount and stay within, say, the 12% tax bracket, whatever that amount is. If I then turn around and put that amount in as a Roth conversion amount and rerun my taxes, what happens? I just completely overshot the 12% bracket. Why? Because part of my Social Security has become taxed. Because that is now taxed, the headroom has shrunk. Okay? This is the problem. There is no formulaic answer, which means we have to iterate. Now, iterating to me feels maladroit and clumsy, so I avoid it when possible, but there's just no alternative when it comes to federal taxes. So here we are doing these iterative calculations that I don't even know how to replicate in Excel unless you want to start doing macros, which means the software industry has to be the one to solve it. I'm sorry, we have failed you. We'll do better. Finally, nominal versus net present value tax savings. This is a tricky one. The reason it's tricky is that it's a little bit deceptive. Imagine for just a minute, if you will, an asset balance where you can have $1 million today, or you can have $1 million 10 years from now. Hopefully, the answer to that question is easy. You take the $1 million today. And why? It's because those two values are not the same. And they're not the same because if you had a million today and you did wise things with it, you would have maybe double that 10 years from now at $2 million. What that means is that today, $1 million is worth about the same as $2 million 10 years from now. Your tax benefit is the same. That's kind of in reverse because the greater dollar amount is less appealing. But if you pay $1 million of taxes today, that's like paying $2 million of taxes 10 years from now by the exact same stream of logic. So the problem with that is that the typical software makes every traditional IRA conversion into a Roth look healthy because almost without doubt, the nominal dollar taxes on a traditional IRA withdrawal that'll happen later down the road will be higher than the taxes that will be paid today in nominal terms. We have to normalize those dollars and look at them in a net present value sense, or we're being a little bit deceived. Now, I tend to take the best of people, and I don't think people are intentionally deceptive. Sometimes the net present value discussion is perhaps just maybe a little too difficult to explain or understand, and so we avoid it and we talk nominal dollars. But that's unfortunate. It means that we're doing Roth conversions when they're actually detrimental to our finance situation. Hey, here's Zach Call again, talking about nominal versus net present value dollars and explaining it in a way that perhaps only Zach can do.
Most software is not thinking about, well, $10,000 of payments and taxes today versus in the future is not the same.
Got it.
So in other words, you come up with false optimal scenarios that are not right. You come up with quote optimal scenarios that are not truly optimal because they're just summing up all the taxes paid.
Get your Roth conversion calculation right. Make sure that you're looking at both sides of the story, right? The in years where you're doing the conversions and the out years where you're withdrawing the funds. Any one of those in isolation just doesn't tell the story. Make sure that you're using a true federal tax calculation that uses accurate, even if they're projected, marginal brackets so that each dollar is taxed at its progressive marginal rate. Phase outs and bans are all taken into account. And finally, be smart about the numbers you're looking at. Are they normalized? Don't compare a dollar today to a dollar tomorrow and assume it's a wash. They are not the same thing. Hey, look, this is a deep conversation. The software industry will do better. I'm on a charge to make sure that happens. So stay with me. Thanks for being here.